Welcome back to the show, Total Financial Solutions Safer Money Hour. Arif Halaby along with Jeff Gerard, and we're talking about your family's finances, some of the key components to a fixed indexed annuity. Remember that you're going to have the cap rate. And that's when Jeff was saying it's not too good to be true, because there is a maximum amount that you can expect to earn. That's number one. Number two is there is also a time commitment, anywhere from 2 years to as long as 16. If you say, I want to take all of my money out, you can. It isn't locked up, but you will pay a fee. However, after the first year, most companies allow you to pull out 10%. Some are 5, some are just the interest, depending on what you're doing, but most of them are about 10%. That means after the first year, if you're going to take out 10% every year, so if you have $100,000, it's $10,000 a year, then you're never going to pay a fee. There's no deposit fee, no monthly fee, no quarterly fee, no annual fee. But if you pull out more than 10%, you will pay a fee. Or if the market does 25%, you're not going to get that. So those are the two trade-offs that make this, quote, not too good to be true.
Yeah, that's a big deal, because so many people get locked into the idea that, either their money has to be 100% liquid, or they want to get all of the upside of the market. And really, if you take a look at being more conservative in the sense that you should have a goal, not to double your money every year or every 5 or every 10 years, but to say, look, I want to get to a particular place when it comes to an income strategy for my retirement. You might sit down with somebody and say, look, I want to have X amount of dollars, and maybe some of that will come from your Social Security. You might get a pension from work. You may have some 401k savings or some type of retirement savings at work, but pieces of that may come over from those various savings accounts that you have in your old 401ks as well, or your old retirement accounts, and roll those into a place where you know that you have a guaranteed amount of income. So now you start to have an income strategy versus just a bunch of money or accounts hanging out there and you don't really know. I can't tell you how many times people have come in and they bring in all of their, they bring in their portfolio and they say, gosh, how much do you think we can live on? Do you think we can retire? Because, and it's a very common thing, because looking at a bunch of numbers in accounts, that doesn't necessarily translate into a paycheck for people. Because you were used to trading your time for money, or creating an effort and being a plumber or a real estate developer, or maybe you painted, or you're a musician. So those all equaled something, and you used part of that money for your expenses, and then maybe you socked a little bit away. But you're used to trading time and effort for money. When you stop doing that for money and you now say, look, I want to start living off of my investments or my retirement accounts, that's kind of a scary place. And that's probably, I would say, at the top of the list of why people don't retire, because they don't know how much of that money they can have last for the rest of their lives. So if you say, look, I have a finite amount of dollars, and maybe I'll make a little bit of interest here and there, but my goal is really safety, and I have to start drawing this down, that becomes kind of a paralyzing thought for people to spend when they know they're not putting it back into the bucket.
Yeah, and part of what you look at is people say, oh, I can withdraw my money and it becomes an income stream, so that means I'm not touching the principal, right? No, you might be. If you were pulling out 5%, $5,000, but your account only earns $1,000, then yes, you're going to be going backwards a little bit. On the opposite side, if the market is doing $8,000 or $10,000 is what you've earned, and you're pulling out 5, then your account does go up. So there still is, a physics at play. There still is a math problem.
Yeah, you have to look at the math.
1 + 1 is 2. It doesn't really change.
That's right.
What you're doing. So as Jeff continues with the show, I want you to focus on 2 things, guys. There is a piece of your retirement account that might be appropriate for fixed indexed annuities. You can come to a firm like ours, or one that focuses on safety for the safe portion, and that's what we're here for. You can always go to hometownstation.com, click on Total Financial Solutions, or you can go to 753-9683. Grab a pen, and I'll tell you again here, 753-9683. That's our office. And Jeff, for our clients, many of you guys listen out there, we have an event that's happening this Saturday.
Oh, that's right. June 18th, we have our client appreciation event. We try to do this every year. This is our first time to do a summertime event. Normally it's based around the end of the year, but our summertime event's very exciting. We're going to be watching a movie, and you just have to get a hold of us at 753-9683, and we're going to extend that to our listeners, it sounds like, as well.
Yeah, so if you are a client, if you're out there listening, you have an invitation, please let us know. We'll be happy to have you come to this event. For more information, give us a call at 753-9683. And I think our clients are allowed to bring a couple of guests. So if you know somebody that's a client, you can piggyback with them this Saturday.
That's right.
We also have a couple of dinners coming up as well that I think, Jeff, you'll cover here towards the end of the hour. But tell me the difference. We have a lot of folks that don't understand the difference between qualified and non-qualified. And I think like every industry, right, you have jargon, which is what you have that is words or terms that are exclusive to your industry, shortcuts, if you will, without big explanations. Everybody knows what everybody knows when you say a word or two. And in the financial world, qualified and non-qualified also fits into that. So give us a definition of what that is, but also, when would I take money from either of those accounts, and where does it come from? I think that can be a great clarity for us.
You got it. So when we're talking about retirement assets, we're mainly talking about qualified funds. And what does that mean? Anything qualified is in the world of 401ks, a 403b, a 457. You heard us talk about this. If you work for a for-profit company, you might have a 401k. If you work for a school or a hospital or research facility, you might have a 403b. County, state, any type of municipality or government type job or anything related to that, you're going to see something like the 457 or deferred comp. Those are all qualified monies. Likewise, if you were to be self-employed and you opened up something called a SEP IRA, which in some terms you might think of SEP as self-employed person, really stands for Simplified Employee Pension. It's just a tax term for this type of IRA. But if you think about an individual retirement account, that is also on the qualified side. And that just means that there are some rules associated with it. When you have a qualified type of account, just think of qualified distributions. Okay, so if you put money in, there's a rule around what happens there. People typically go into qualified accounts for the tax benefits, and let me talk about what those are. When it comes to taxes, and look, just about anything can be a qualified or non-qualified account. You can have a CD at the bank that's either an IRA CD or a non-IRA CD, and I'll talk about the differences here in a minute. You can have an annuity that is an IRA or a non-IRA annuity. You can have a mutual fund or stock or bond, anything like that that can be an IRA or a non-IRA. And the difference is simply this. When you put money into a qualified account, those rules are attached now. The government, the IRS, says, okay, what happened when you put those dollars in? You put the monies in today. Did you not pay tax on that money, or did you get a tax break for putting money into that account? If the answer is yes, it's probably qualified. So when you start to look at that, you say, okay, great, so I got a tax benefit today, but the government wants to entice us to leave those monies in those type of accounts. So they give us the tax benefits and the tax breaks today, but they say, look, if you take the money out of that account, you're going to pay tax on it. And if you do it before, what's typically age 59 and a half, there's a rule that says if you take out money before that, they also charge an additional 10% penalty. So when you're looking at qualified retirement plans or qualified retirement accounts, these are the accounts that you want to put money in that you're not going to touch until you actually reach retirement age. So for most of us, it's 59 and a half, right? And why they set it for that age, we're not really sure with the little half in there. You could just say, hey, look, if they wanted to make it really simple, look, put money in, get the tax break today, make sure you take it out after age 60, and you won't pay any penalties, but you'll pay tax. It could be that simple, but it's not. In most cases, people will wait till after they're age 59 and a half to access these funds. If you want to take them out earlier, there is a provision because, look, we know rich people make the rules, right? In this country, that's the way it is. Rich people like to retire before age 59 and a half, and they still like to put money into retirement accounts where they get the tax break today. So if that's important to you, you can always get a hold of us. And in very, I would say, niche cases, it makes sense to take money out prior to that. So you're going to want to check with your CPA and your financial financial team to make sure that it is a fit for you. But there is a way to take money out before age 59 and a half, and it's a little provision. Doesn't bend the rules in the sense that it's illegal or anything. You can totally do this. It's legal. Some people do this, but like I said, it has to be right for you. And you can access those funds. You'll still pay taxes, but you won't pay that extra 10% penalty. And look, some people are okay with it. They'll put money into IRAs, 401ks, and when they leave a job, they say, you know what, or they have an emergency, they'll tap some of these monies, and they'll say, look, I know I have to pay tax, and I know I'm going to pay that penalty, but you know what, it wasn't some of that wasn't my money to begin with. Well, I would caution you to say that the sooner you get into your head that these are monies designed for retirement and they have a job to do, and you don't have them do other jobs like pay your mortgage or your cell phone bill or your car payment, that's the right mindset, I think, to have around these types of accounts. So qualified retirement plans means you put money in, typically pre-tax, but not always, and you want to touch this money after age 59 and a half. Now, a non-qualified is on the other side of the spectrum of taxes. Now, when you put money into this type of an account, you don't see a benefit on the tax side today. It would be the same as if you took the money from your purse or your wallet or your pocket and you said, I'm going to deposit X amount of dollars into a savings account at the bank. That would be, and they don't call it, you won't walk in and say, I want a non-qualified savings. You would just say, I want to open a savings account. So you're checking, you're saving. Those are types of non-qualified, meaning they don't have any retirement rules associated with them. You can put the money in, you can take it out as often as you want, and there's no extra penalty there. Now, if you earn any interest in those accounts, then that would be subject to tax. Oh, and let me go back to the other side real quick. On the qualified side, when you put money in, you got the tax break today, right? So if you put in $1,000 or $100 into your 401k or your IRA, that money sits off to the side and hopefully earns interest. And when you take that money out, not only is it the money that you put in, but any money that is earned in that, that's all deferred from taxes, right? But when you take that money out and it crosses back over into your hands, all of it is subject to tax. So we want you to be cautious in putting too much money, or to not put too much money, I should say, all in the qualified side, because you want to have some tax diversity as well. Everybody looks at diversification for retirement. They want to say, I want to have different streams of income and different assets in different places. Well, that's fantastic, but is your tax conversation diversified as well? Because if all of your money's coming out and is taxed, that could be a bit of an issue. You could be looking at a higher number that you have to achieve just to net a smaller number. So for example, if you have $1,000 that you want to take out of your IRA and it's qualified, or your 401k, and you've never paid tax on it, and you say, look, I need $1,000, you might have to take out $1,200 or $1,300. That's an extra amount of money that has to go off to taxes before you can net, and catch that $1,000 in your hand. So on the non-qualified side, you don't have that same conversation. You say, look, I put the money in, I take it out, and here's some examples. If you were to sell a rental property or inherit some money, if you wanted to take that money and invest it somewhere, or put it in a place where, let's say in this fixed index annuity, that could be a non-qualified example, which just means simply this. You put the money in, you don't get a tax break for it. Any interest that you earn is subject to tax. And when you take the money out, that's when it would really count towards your taxable income. But the money that you put in, you never pay tax on that again. So that's kind of a nice thing. So you're not paying taxes on any of the profits, though. And let me clarify that. In a fixed index annuity, you do have some tax deferral, but when you put the money in, you don't get the break. When you take it out, that's when those taxes would be subject on just the interest itself. If you have any more questions on any of this, whether it's an income annuity, a fixed index annuity, or anything of the sort, retirement income planning wise, I encourage you to give us a call at 753-9683. You can get a hold of Arif, Halaby, or myself. We'd be happy to answer any of those questions for you. Thanks for listening. Join us every week at this time, Tuesdays at noon, on your hometown station, AM 1220 KHTS. This is the Safer Money Hour. Thanks for listening.